Gold keeps hitting all-time highs, and everyone's celebrating. But here's what they're not telling you. Every time in history gold has done this, something catastrophic followed. Not in years, not in months, but weeks. The warning signs are already flashing, and most investors are completely blind to them. So stay with me, because by the end of this video, you'll see exactly what's coming. Most people think record gold prices mean safety, stability, a smart hedge against uncertainty. And on the surface, that makes sense. But when you look at what's happening beneath the market, when you see who's actually buying and why, you realize this isn't protection. This is panic. And panic always comes right before the collapse. What gold is screaming at us right now isn't buy more, it's brace yourself. Let me ask you something. Why is gold surging to unprecedented levels when every economic indicator says it should be crashing? The central bank is tightening. Interest rates are up. The Fed's balance sheet is contracting. According to conventional monetary theory, gold should be in free fall right now, but it's not. It's doing the opposite. It's climbing higher every single week. This is the paradox nobody wants to address. If you're finding this perspective valuable, go ahead and hit that like button. It helps more people discover what's really happening. Now let me show you something. Here's what mainstream economics teaches you. Gold is static. It's not productive capital. It doesn't generate cash flow. It doesn't innovate. It doesn't expand. A gold bar that existed in the vaults of ancient Babylon would be identical to one sitting in Fort Knox today. Same atomic structure, same weight, same properties. This is why neoclassical economists call it a relic, a barbarous remnant of pre-modern finance. But here's what they miss. Gold has outlasted every single monetary regime in human history, every empire, every currency collapse, every hyperinflationary episode. Why? Because it cannot be manufactured at will. And that's not a bug. That's the feature. To grasp what's really driving this surge, you need to understand what gold is actually priced against. It's not measured in abstract units. It's measured in dollars. And the dollar's relationship with gold tells you everything about monetary debasement. Go back to 1971. Nixon severed the last link between the dollar and gold reserves. At that moment, gold was trading at $35 per ounce. $35. Now we're looking at prices well over $3,000. What transformed? Not the gold. The same ounce that existed in 1971 exists today. Same molecules, same inert metal. What transformed was the currency. Fiat money operates under a completely different set of rules. It can be conjured into existence whenever the political system demands it, and demand it they did. Look at 2008. Before the financial implosion, the Federal Reserve's balance sheet held around $800 billion. Then Lehman Brothers collapsed. And what happened? The Fed's balance sheet tripled almost overnight. They flooded the system with liquidity to prevent a complete meltdown, and in doing so, they fundamentally altered the perception of dollar stability. Gold responded immediately. It began its long march upward. Then came 2020. A virus shuts down the global economy. The Fed's response? Even more aggressive monetary expansion. The balance sheet exploded to nearly $9 trillion. Think about that. $9 trillion created in a matter of months. The monetary base expanded vertically. And once again, gold surged. Not because gold became more valuable in any intrinsic sense, but because the measuring stick itself, the dollar, was being systematically diluted. Now here's the twist. The Fed has been attempting to reverse course. They've been shrinking the balance sheet, raising rates, projecting hawkishness. Classical theory says gold should collapse under these conditions, but it hasn't. It keeps climbing. That tells you something profound is happening beneath the surface. This isn't just about monetary policy anymore. This is about a structural shift in global finance, a loss of confidence not in gold, but in the system that issues the dollar. And that, my friends, is what the financial press refuses to confront. We're watching the slow-motion erosion of dollar hegemony, and gold is the thermometer measuring that fever. For 70 years, The dollar has been the anchor of the global monetary system. It's been the reserve currency, the settlement currency, the only asset central banks truly needed to hold. Nations accumulated U.S. Treasury bonds, convinced they represented the safest store of value on the planet, but that consensus is fracturing, and it's fracturing fast. Look at China. For decades, they were among the largest foreign holders of U.S. debt. But over the past few years, they've been systematically liquidating those positions. And what are they buying instead? Gold, not modest amounts. We're talking hundreds of billions of dollars redirected into bullion. Why this shift? Because gold cannot be weaponized against them. It can't be frozen by executive order. It can't be seized through sanctions. It exists outside the jurisdiction of Washington. Now consider Russia. After being cut off from SWIFT and the Western banking infrastructure, Moscow accelerated its gold accumulation to unprecedented levels. The Russian central bank is now one of the top holders globally. They learned a harsh lesson. Financial connectivity is a vulnerability when your adversary controls the rails. Gold eliminates that vulnerability. And then there's India, historically a modest holder, but in recent years, India's reserves have been growing at record pace. Why? Because they're anticipating a multipolar monetary order. These aren't random decisions. This is coordinated de-dollarization. These nations and dozens of others are hedging against a future where the dollar is no longer the uncontested king. And the only way to hedge against that is to own the one asset that no government can devalue by decree. That asset is gold. This is the tectonic shift happening beneath our feet. So this is what's actually propelling gold to these heights. Not panic over monthly inflation prints, not speculation about the next Fed decision, but a profound reallocation happening at the institutional level. The world's largest economies are systematically converting paper claims into physical metal. And this movement isn't confined to sovereign actors. Private wealth managers are doing it. Pension funds are doing it. Family offices are doing it. Even retail investors who've never touched gold before are starting to accumulate. Why? Because they're looking at the fiscal trajectory of the United States and asking a very rational question. Can this possibly be sustained? U.S. federal debt has now breached $30 trillion. Annual deficits continue to widen with no credible plan for reversal. Every crisis triggers another round of monetary expansion, and each expansion further undermines the foundational credibility of the currency. People aren't stupid. They see the writing on the wall. This isn't about the Fed's next interest rate adjustment. This is about a fundamental realignment of trust, a recognition that the old order is unstable. And when instability becomes the baseline, you don't wait for confirmation. You move. Think of it this way. You're on a vessel that's been seaworthy for generations, rock solid. Then you notice fractures in the hull, minor at first, then more pronounced. You attempt repairs, but the cracks keep spreading. Deep down, you know the integrity is compromised. What's the rational response? You secure a lifeboat, not because you're panicking, because you're prudent. Gold is that lifeboat. It's the asset you turn to when the system itself becomes the risk. Now let's quantify this. 25 years ago, gold traded at $279 per ounce. Today, over $3,500. That's a 1,200% gain. Not bad for an asset dismissed as unproductive. Meanwhile, U.S. national debt has exploded past $30 trillion with no end in sight. So here's the inevitable question. When a government owes more than it can ever realistically repay, what are the options? Only two. Default outright, destroying credibility instantly, or inflate the debt away by printing more currency. And history is clear. Governments always choose inflation. They print, they dilute, they debase, which means the dollar will continue weakening and gold will continue strengthening. Will gold hit $10,000 overnight? Probably not. But is the upward trend locked for the foreseeable future? Absolutely, because this isn't about gold becoming something new. It's about the dollar becoming something less. That's the structural reality we're living through. And here's what should disturb you. Gold's surge isn't just a financial phenomenon, it's a diagnostic signal. It's telling us something profound about the state of global trust. This isn't simply a chart trending upward, it's a barometer of systemic confidence. And right now, that barometer is falling. When central banks, sovereign wealth funds, and major economies all converge on the same asset simultaneously, that's not coincidence. That's not speculation. That's survival instinct kicking in. So the next time you see gold prices flash across a screen, don't just see it as a commodity quote. See it as a thermometer measuring the fever of the entire financial architecture. And that fever, it's climbing. The mainstream press won't frame it this way. They'll talk about interest rate expectations, inflation data, bond market volatility, but those are surface phenomena. The deeper force, the one that's truly driving this, is a mass exodus from paper claims into tangible assets. That's the real story behind gold's rise. And once you understand it, you realize this isn't about next week's price action. This is about the next decade, the next generation. So let me pose this to you. If the world's most powerful economies are positioning for a post-dollar era by accumulating gold, shouldn't that give you pause? Shouldn't you ask yourself what they see on the horizon that you don't? Because by the time this becomes obvious to everyone, the window to act will have closed. If this analysis has shifted your perspective, I'd appreciate it if you'd hit that subscribe button and drop your thoughts in the comments below. Let's keep this conversation going. One final note. I'm an economist, not a financial advisor. This discussion is for educational purposes. Any decisions you make are your own responsibility. Take care of yourself, and I'll see you in the next one.